Hey, Jason here. Today we get to part 2 of answering the question, is Ternium still stock? There we go. Ternium, stock ticker TX, a good investment. Today we're going over the full preliminary analysis, which you see on the other screen over here, and we're going to get to that shortly. Before I get to that, though, I need to let you know you can get this series of podcasts anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. You get this as part of the I Love Value Investing podcast anywhere in the world for free. If you like this video and our other videos here on YouTube, make sure to subscribe and hit the notification bell so you're notified every time we release a new video, and release new videos all the time. Brief disclaimer today, not as long as my initial stock analysis videos. This is for informational purposes only, to help you become a better investor. Make sure you do your own research when you analyze stocks. This is just what I'm seeing when I look at, and I'm pointing to the other screen over here. This is just what I'm seeing when I analyze this stock. I own no stock in this, and I also, in a long position, I also don't short sell ever. So I don't benefit any way. This is for your purposes only, to help you learn how to evaluate stocks better and faster. Okay, so in part 1 of the Ternium video, we found out, looks like a pretty good stock. The numbers you see over here right now are not the new updated numbers. These are from the stock analysis, the preliminary analysis, part 2 for Grand Canyon Education, stock ticker LOPE. If you want to see that video, make sure to check it out on YouTube. Links below, should be somewhere around here, to see part 2. We're about to update the videos here, or update the information here for Ternium. Again, we found out it was a great stock in stage 1 of my analysis. This is stage 2. So let's get to it. Okay. Get that out of here. Okay. Check on the other screen. And okay, both screens are showing up. Cool. Okay, so again, we found out here that in the first video, Ternium was good. This one, in this stage of my analysis, my second stage, we actually write stuff down, and down here is the most important part, because we start doing relative valuations and calculating enterprise value. Again, we'll get through that as we go through it, sorry. But we have to do that. We have to go through the worksheet. 5.4, and there is a large dividend. Large dividend, that's good. And I apologize, if you haven't seen any of these other videos or listened to these other audios for the stage 2 of my analysis structure, what we're going to do here is we're going to go through this worksheet that you see if you're watching on YouTube. If you don't, if you're listening on the podcast, for these videos, it's probably best to listen on YouTube. And so make sure to go to YouTube to check this out, because you can actually see the worksheet, see Morningstar, and see what I'm actually looking at when I talk about it. But having said that, we're going to go through here what is on this worksheet, what it means, why it's important, and all that. I'm not going to go through everything in depth as I would with a student, because I've done a bunch of the videos on these, and frankly, you can watch the other videos for free if you want to learn every single nuance about everything. But I'm going to try to only hit the highlights here. Okay, so operating profit in the trailing 12-month period is 25.7. 5-year average operating profit is going to be lower. 12.4 plus 8.5 plus 18.4 plus 15 plus 15.8. And the main reason I'm talking is for those who are watching on the podcast, because they can't see what I'm talking about. Okay, 12% rounded up. Okay, point 1. Trailing 12-month period operating margin is 25.7%. 5-year average operating margin is 12%. The trailing 12-month operating margin is more than double higher than the 5-year average. Why? We talked about this in the last Ternium video. Likely a huge part of it is due to the increased value of commodities, and among them being things like steel. With the inflation that's going on in the U.S. and worldwide right now, with the supply shortages that I got into in video part 1, which again, you can find below this for free. We need to figure out, if we continue doing this analysis, are these prices likely these high prices likely to continue, which means higher revenue, higher profits, higher cash flows. Do we expect that to continue? Will it go back to the 5-year average operating margin? Will it be somewhere in between? Again, as I said in the video number 1, I think it's probably either over the long term, likely closer to the 12% range, maybe somewhere in between, because again, right now we're seeing crazy inflation like we haven't seen in 20, 30, 40 years, depending on where you're living at in the world right now. And with that inflation, when that ends, whenever that ends, will lead to lower steel prices and stuff like, and lower revenues, and lower profits, low cash flows, all that stuff. Okay. Share count has stayed about at 97 million since 2011. Since about, about the same at, there we go, since 2011. It's only changed by 1 million shares in the last decade, so frankly, that's not even worth calculating out here. Book value per share going up 28.74 per share in 2011 to 43.55 per share in the trailing 12-month period. That's a fantastic amount of growth. Let's see what that calculates out to. 5 minus 8.74. That is 51.5%. Why look at this number? Even though book value, frankly, doesn't matter as much as it used to. It matters more for Ternium than most companies we look at because it's a manufacturer. It's a hard asset company. Book value matters more for hard asset companies. But even still, book value doesn't matter as much anymore as it used to. So why am I looking at book value at all on here? Because I'm looking to see the trend of this. Is it going up? Is it going down? Is it staying about the same? If it's going up, that's a decent sign. The underlying intrinsic value of the company is going up over time. Why? Because book value is based on the balance sheet, and this means the underlying balance sheet strength is getting more valuable over time. Now, having said that, this we will figure out if this is really a big deal when we get to other stuff like goodwill and talking about intangible assets and stuff like that. Okay, ROIC, fantastic, 24.2%. Morningstar 5-year average is 4 plus 6.9 plus 19 plus 13.8 plus 11.5. 5, so 11.9%. Again, ROIC is a lot higher in the trailing 12-month period than in the 5-year average for the reasons I talked about earlier with steel prices going up, blah, 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 blah. Again, with all these metrics we're going to look at, we need to figure out, at some point, we need to figure out do we expect the margins to stick with the trailing 12-month number or go back to the 5-year average? I'm going to say that again when we get down to free cash flow to sales in all likelihood. But why do we need to figure this out? Not only for the long-term kind of outlook of the company, but if a company has a 25% operating margin, for example, it's valued at a far higher rate than a company that has a 12% operating margin or a company that has a 5% operating margin. So these things affect valuation as well, which is another reason they are on here. 31.4 for the ROE, return on equity, in a trailing 12-month period. 1.2, 5-year average. 7 plus 26.4 plus 18.9 plus 14.1. Excuse me. 15.9, rounded up. Again, ROE, massive discrepancy in the 5-year average at 15.9% versus the trailing 12-month period at 31.4% for the reasons we talked about. The main reason I look at ROE, though, frankly, I don't look at it for any other reason other than to see if it's higher than ROIC, because if it is, that means the company has debt. And the higher that number is, means the more company or the more debt the company has. In this case, it's a decent difference, 31.4% trailing 12-month ROE versus 24.2% trailing 12 months ROIC. So not a huge difference. We'll get to those numbers down here more when we talk about enterprise value. Okay. How much free cash flow for sales? 12.8. 5-year average is 13.8 plus 5.8 plus 10.6 minus 0.3 plus 9.2, 7.8%. Again, pretty large difference here, 3 percentage points, from 7.8% in the 5-year average to 10.8% in the trailing 12-month average. I look for anything above 5% here, so this surpasses both of my thresholds, as do pretty much all of its numbers. But we need to figure out, again, for the same reasons we talked about above, what is going to sustain over the long term. Cash conversion cycle is about the same. Gone up from 101 days in 2011, rounded up to 104 days in the period, or an increase of 3% rounded up in that time. Again, normally I wouldn't even calculate that out, but cash conversion cycle, again, matters for this company because it deals in hard assets, so we want to see what's going on with this company, and it's about the same. Why is it about the same? Their days sales outstanding is higher by about 18 days. Days inventory is about the same, and the payables period is up by about 15 days as well. So that's why their cash conversion cycle has gone up only slightly, even though sales, the amount of time it's taken to sell something has gone up by about 18 days, but the payables period has also gone up by about 15, 16 days. Those kind of offset each other, and in this case, not a huge deal either way. We will get into other companies where this is a massive deal, especially for things like inventory, payables, sales, all three of the individual numbers that go into this. The sales outstanding number here is the bigger deal for me, but it's not a huge deal anyways, because frankly, steel is, until we figure out something else that is economical and sturdy and can withstand various real world conditions, we're going to keep using steel. So frankly, it doesn't matter a huge amount in this case. Okay, so that's it for this section right here. Pretty straightforward. So far, Ternium still looks like a good stock. This is where we really get to the meat of this worksheet though. And again, all this stuff up here, we went through it pretty fast. I've got training videos and training sessions with students where we talk about this for an hour and a half and go into every single nuance. So just because we went over it fast doesn't mean it's not important, because everything is on here for a reason, especially cash conversion cycle. Everything is on here for not just one reason either. It's on here for multiple reasons, especially cash conversion cycle, because this can literally, this one number, show you 8 to 12 different things about a company depending on what it does. Okay, so we need to go down here, 10, 5, 3, 4. So these numbers are in millions. As you can see here, we're going to start calculating enterprise value. Why? What is enterprise value? If you haven't seen my other videos, enterprise value is, to me, a more true look at the value of the company because it includes both cash and debt and other things, which we'll get to in a second. But it's a more true value than market cap, because since 99% of all companies on Earth have either cash or debt or both, you want to know that as a total business owner. And that's how I think of looking at any investment, as if I were to own part or all of the business, because that's in a sense what you're doing, in my view, when you're becoming a shareholder. You're owning part of the business. Okay, so I want to know this number. Okay, let's bring up the quarterly balance sheet. You always want to use the trailing 12-month or the most recent balance sheet, and that's the quarterly for U.S.-based companies. Most companies worldwide only do annuals or semi-annuals now. You'll also probably get there eventually. 13380. These are in billions over here. Okay, what do we need next? Short-term debt and capital leases. We need, okay, where's the total number? Total debt, current debt and capital leases, 0.64. So 640. Long-term debt. Did we pass it? We did. 1.21. 210. Preferred. Don't have any preferred stock. And oops. I also don't have any minority interests as well. Most companies, especially smaller, somewhat newer companies, don't have preferred stock. And many companies also don't have minority interests as well. Minority interest is things in ownerships in other companies, smaller companies typically, that they own, let's say, 10% of. And I'm just checking up here just in case for minority interest, because sometimes that hides elsewhere. It's not long-term equity investments. Long-term equity investments are specific, like stock investments. Yeah, there will be a separate category here for minority interest if there is any. And I'm not seeing any. So let's calculate this out. 10,534 plus 380 plus 640 plus 1210 equals 11.04 billion. 4 billion. Okay, what does this mean? That its market, or that its enterprise value is higher than its market cap. It's one sign the company might be overvalued. Why is that? Because it shows that the company has more cash or more debt than cash. And when that happens, it adds to the company the price you have to pay for the company. What that means, we'll see up here for sure, but it's one sign the company could be undervalued. 04, the EBIT numbers, which is 3055 for EBIT 5, and free cash flow is 1288. Okay, so now enterprise value divided by EBIT, trailing 12 months EBIT, is 4 divided by 3055. Oops, didn't multiply. Let's redo that again. 4 divided by 3055 equals 3.660, rounded up. Free cash flow 4 divided by equals 8.54. So what these illustrate is a bit of a confusing picture. One metric, EV to EBIT, shows that the company is massively undervalued. I look for this number to be below 8, and it's at 3.6. That's one of the lowest valuations, relative valuations I've seen. However, the EV to free cash flow shows a number of 8.54, which is slightly above what I look for to consider a company undervalued. What does that mean? Let's keep going before I get to that, to the earnings yield. So reverse these numbers. 3055 divided by 0.4 equals 27%, 27.8% specifically. 288 divided by 11.7%. What are earnings yields? Earnings yields show you, based on the information today, the company, or this is the amount if you bought the company today with its current information available. This is what you should expect to earn owning its stock in the next year. 27.8% is a fantastic return. 11.7% is a pretty good return. there's a massive difference here in what you should expect to earn. And the reason I say expect is because it never actually turns out you earn 27.8% in a year, for example. These are just ranges. So what are my thoughts on Ternium so far? Because so far it surpasses pretty much all my thresholds. The big thing here is that I keep coming back to is the price of steel. The price of steel, again, is up drastically in the last year due to supply chain issues, inflation, all the stuff we're seeing right now. So another way to look at this is to do another EV/EBIT normalized 5-year average EBIT. Okay, so what that means is 4 divided by the 5-year average operating margin was 12%. So we go up and go back over to the other sheet. 12% times 11887, which is their trailing 12-month revenue, is, where are we at here? There we are. 1426. So equals 1426 divided, oops, wrong one. So 7.72. So that still shows the company is slightly undervalued. I would highlight this. Okay. Oops, let me get this out of here. So what that means is the company is still slightly undervalued if we assume a 5-year EBIT average. However, that's still not the case because we'd have to also get the 5-year average revenue because remember, steel prices don't just affect profits, although they affect profits more when prices rise for companies if they can pass those profits along. It also affects revenue. So what is there? 7224. Oops. Divided by 5. So their average is not normalizing revenue. Okay. So, and okay, so if you're listening on the podcast, I wrote a couple notes in here on the worksheet. On the first one we just did, I put a note in here, normalizing 5-year average EBIT, not normalizing revenue. I also added the next section, which we're about to do. Normalize 5-year average EBIT and normalize revenue. Because again, if we're going to normalize one, you have to normalize the other one as well. So 9461 times 12% equals 1135. Oops. 35. 9461 divided by, and that gets us to a slightly above value or overvalued stock at 8.34. This, to me, as a extremely conservative value investor, would mean to me that the company is slightly overvalued right now. If it goes back to higher profit or lower profits, lower revenues after the inflation and high steel prices end. Does that mean this is a bad stock now all of a sudden? No. But I want to play worst case scenario as well, or not worst case scenario. I want to be as conservative as possible in my estimates, which is why I did this valuation. Why did I do this valuation as well? was because I think this is frankly realistic. I don't think steel prices are going to be elevated forever. I don't think, and when they do, steel prices are going to fall, and that's going to lead to lower revenues, lower profits, lower cash flows, like we talked about. So I think it's closer to this value in a real world sense. Again, could be proven wrong, but again, I want to be as conservative as possible in my estimates. So what does that mean for the analysis of the company? Frankly, this still looks like a reasonably good investment. Even if their numbers go back to their 5-year averages, they're still above my thresholds. They are becoming more efficient over time with their cash conversion cycle, staying about the same. And they are about fairly valued. I look for stocks to be undervalued or fairly valued. I won't buy anything if it's overvalued, but if it's fairly valued, I'll consider it if it's great. Does it fall into that category yet? Not necessarily, but this is definitely enough to continue doing analysis on. So that is what we're going to do. There will be a part 3 of this analysis. And let me get you back over here. And what we're going to cover on that is we're going to start going through the 10K for Ternium, like we did with, or like we're still doing with WidePoint. We're going to start going over that and just seeing what we can find out in their financial reports, their 10K specifically. Why is that important? Because you can't just rely on the metrics ever, as we just found out in the WidePoint video. Again, we're still doing that series, but in the last video, if you watched it, and you can see that somewhere on this page in the description, is we found a major red flag that we need to figure out with WidePoint. So we're going to do the same thing with Ternium, and that will be in the next video. But hope you enjoyed this video. If you're watching on YouTube, make sure to like, love, share, subscribe, all that good stuff. Make sure to comment as well, and make sure to hit the notification or subscribe and hit the notification bell so you're notified every time we release a new video. We're releasing new videos all the time. If you're listening on the podcast, we really appreciate all that same stuff. Make sure on the podcast, though, to leave a review, because the more reviews, views, and listens we get to our content, the more people we can help. If you're looking for more specific information on how to become a better investor faster, check out our free resources below. You can get our 5 free gifts, which includes the worksheet we just did, so you can analyze stuff like this as well. You can get that as part of 5 free gifts. You can also get a free PDF copy of my book, How to Value Invest, and a free PDF copy of our guide, 7 tips to picking great stocks and 3 times you must sell. You can get all 3 of those for free at the links below. If you're looking for more specific help from me on how to become a better investor faster, make sure to check out our newly relaunched masterclass, and you can find information for that below as well. But until next time, have a great day. Talk soon.